All right, guys. I was wondering, excuse me, you have to forgive me about my cough. I was wondering how to distribute the EA that I promised I would be distributing. So I thought instead of me individually mailing you folks who registered for joining the session, I'll just give you a link and you can download the EA that we will be using later. Okay, so again, forgive me for my cough, but well, again, that's the link to the EA that we will use after this session. So anyway, welcome to this class. This is Mark De La Paz from FX Instructor. Our topic, well, the topic for today in FX Street is about news trading. My particular topic is called trading the news dumb and managing your trade smartly. What do we mean when we say trading the news dumb? Essentially, it means that it is possible to take a trade, to trade the news without being or without having a PhD in economics, without extensive preparation in forecasting what the data is going to be. What's important is you know your basic economics, you know your you've got some discipline when it comes to trading. Okay? Now, let's move on. Now, it used to be when trading, especially Forex trading, was slightly new, that trading was easy. I was a broker before, and when I talked with my old clients when I was a broker, they would tell me, you know, Mark, when I was new at this game, everything was so easy. We will only look at the stochastic, and if stochastic is above 80, we would start selling, and if stochastic is below 20, we would start buying. Trading the news in the early days of the FX market was also easy. We didn't have MT4 then. We didn't even have Reuters 3000 or EBS at that time. People would call what we now call voice brokers. And these voice brokers would give people prices. Now, we also got our news the same way. People would call their voice brokers, would check, hey, what's the rumor? What's happening? What are we expecting today? And everyone in the trading floor would start listening to the squawk box, basically announcing whatever news that their telex machine would be releasing. So they've got a lady or some new guy beside the telex reading whatever news comes out from the telex and shouting that news to the squawk box. Another way of getting information on economic news was you just watch TV, and if there's a release, then you trade that release. But again, this was back in the 80s, this was back in the mid-90s, okay, before the internet became the internet that we now know. So the way we traded then was we wait for the news. Maybe we have some rumor on what the data is going to be, and everybody jumps into the game once the news gets released. Because we look at the TV or we read the news from the telex machines, we basically get the information all at the same time, which means that in the 80s, in the mid-90s, whenever a news gets released and that news is significant enough to move the market, is far enough from what the consensus was, then we would expect that the market would move, and we would expect that price action to be sustainable. It will just go on and on and on, at least for the rest of the day. But that was then. Now, uh, from the mid-90s to the early 2000s, innovation came into the Forex market. The Bloomberg terminal became popular. The Reuters 3000 became popular. And EBS was established. Basically, these are the earliest electronic trading platforms that we had. People still, for the most part, traded voice with their brokers. They would still call their brokers to do a transaction. Sometimes they didn't call their brokers, but they used the EBS, their electronic trading platform. Although at that time, people weren't really that comfortable with trading by clicking, or no, there wasn't much clicking then. People would press buttons in their keyboards. But again, they weren't really all that comfortable at doing that at the time. So they still, for the most part, would have called their brokers. A new innovation that was brought by these trading platforms that even now is still used by the professionals, by the big guys. Okay, these things continue to exist, and these things are still used by the big traders, by those who trades in the hundreds of millions, in the tens of millions. An innovation that was introduced was the chat. Okay, everybody chats now, but back then, the EBS, the Reuters 3000 had the chat, which allowed the traders to leave messages with their voice brokers, especially if the voice broker is on the phone, busy talking with so many traders. Again, they use the chat to distribute the news. Okay, but still, people get the news relatively in the same time. We still had to watch the news. We still have to wait for the release. And we still have to type our orders in our trading platforms. Now, this lasted until early 2000, 2003. That was still the way things worked. But by the middle of the 2000s, more innovation came in. And this came in the form of machine-readable news. So basically, in the 80s, in the 90s, when we traded the news, we had information roughly at the same time. We still pressed our keyboards or called our brokers to tell them, buy this, sell this. But when I'm not exactly sure when this all started, but I noticed that around 2006, 2007, trading the news changed. It used to be that 2004, 2005 data would come out, market would jump up, market would jump down, and then we will see some seesaw action as market makers decide what to do. This was when there were still a lot of market makers out there. Okay, some of those market makers have merged, some of them have shut down. Now, sometime around 2006, 2007, 2005, a new form of service came to be introduced in the market. These are what we call ultra-low latency news services. These guys provided the news still, okay? But instead of giving us a printout of the news, instead of giving us a text of the news in our trading platform, or the news in the websites, or releasing the news in TV, this ultra low latency news was machine readable. It was meant to be used by what we now call algo systems. It was meant to be used by programs. Boyki, that EA is supposed to be put into the experts folder of MetaTrader. So it's for MetaTrader traders only. So when machine readable news came out, this meant that the rich big market makers suddenly had an edge with the rest of the market. While a human trader would look at the news, would think, what the heck do I do? Even if we planned ahead of time, this is what I'm going to do if this kind of data comes out, we were still left behind by the market makers, by the dealing rooms that used machine readable news. Okay, basically news comes out, and after these data services send the news to the dealing rooms, the servers, the computers of the market makers would process the news. No more human intervention. No more person reading the news that, oh, this is good news. Oh, this is bad news. Everything became electronic for the market makers. So what happened? What happened was, if the news gets released at 12:30 GMT, we human traders would probably see the news, what, 12:30 and 5 seconds, 12:30 and 10 seconds into the minute of the release. But these systems, these algo systems which the market makers now use, they get the news a nanosecond after it comes out of the different feed services, which means that their platforms get to jump the prices on us. So that's why these days, whenever we have data and it's significant enough it's far enough from the consensus forecast, we normally get a jump in prices, and then what happens? And then things go steady. As I said, back in 2005, 2004, you'd look at the news, data gets released, price activity becomes wild, but these days, you get the news, and prices would all jump to a certain level, and then stabilize there for a couple of seconds. Now, how does this whole thing works? Basically, the way the machine readable news works is like this. Data gets released. Once that data gets released, the algo systems of the market makers will collect that data and will compare it with built-in scenarios. Now here we have what we would call an easy, I forgot what to call this, a simple description of how data gets interpreted. Now later we will have jobless claims. Say I were a market maker. How would I program my system in such a way that a nanosecond after I get the data, my prices would be updated. My prices would change. I'd probably do it like this. If jobless claims comes out, okay, consensus forecast according to FXT's website is 375,000. Say jobless claims comes out less than 375,000. Now, a market maker or a dealer would think, hey, that seems to be good news for commodity currencies. So if the jobless claims comes out less than 375, comes out less than 355,000, then I will tell my algo the next quote that you give the market should be plus 10 pips from where it was in the last quote. And if the number is really good, less than 325, then you quote the market plus 25 pips of whatever the last price was that our system sent out. Now, if the jobless claims data turns out bad, comes out at 410,000, then the market maker would program his systems, all right, for Aussie, you quote a price that is 25 pips below the last price. So what happens? Okay, it would take a computer less than a second to process all this, while we're still waiting for Bloomberg TV or maybe the FX Street website to give us the figure. Our market makers would already jump prices less than a tenth of a second. As we said, it takes a nanosecond only. It would jump prices to the next level, which really means that retail traders are at a disadvantage when they're trading the news. Now, in case the news is really good and the market maker's platform, the market maker's algorithm detects that in their order books an increasing number of people are starting to buy Aussie, they may decide, okay, if that's the case, looks like momentum is building, then the trading platform will say, or the algo, the quoting algo will say, plus add another 3 pips to whatever the current market price is. By the way, this is one way of determining whether your broker is actually processing your trades through STP or whether it's making the market first. Because if it's processing through STP, you'll just see those price codes change and change. Whereas most brokers that would make the market would probably have a delay there. Their own algos would receive the price from the market maker and analyze, do we move the price up or are we going to stay at current levels? Some brokers use a system that would monitor price ticks, and if a price quote is far from what the average is, they would disregard it. So you'd note that a broker that is a market maker at the same time would not move their prices as fast because it is based on collated prices from multiple sources. So guys, that is the edge that market makers have on us retail traders. They get the news a lot faster than we do. Now, that's not the only problem of a news trader, okay? Inevitably, when you're trading the news, the forecast on what the data is would be wrong. Actually, wrong forecast is good for us. The more far off the actual figure is from the forecasted data, the more likely that prices would move. The only problem that we have is, of course, as we said, the market maker has an advantage over us. Okay, let's move on. Another problem when trading the news is this idea. We often hear this: buy the rumor, sell the fact. What does that mean? Buy the rumor, sell the fact simply means that if you're expecting that, or rather, if, what's the data today? Yeah, today we're going to get that, that initial claims data from the US. Buy the rumor, sell the fact simply means that if there's a rumor that initial claims will turn out at 420,000, then even before the data gets released, you might see risk aversion in the market. you're going to see your Aussie dropping. You're going to see your dollar CAD going up. You're probably going to see your dollar yen dropping because of that rumor. What does sell the fact mean? So some traders, because of that rumor, would be buying the idea. So they would sell dollar yen as part of buy the rumor. Now, as it turns out, numbers were not exactly the 420,000 that people that the rumor said. If it turns out that way, then people would reverse their transactions. So a problem again of fundamental trading is, how do we know that the data has been priced in? Did market do buy the rumor already, that we're now going to get a sell the fact response? Or is this data something that we can still react to? And as far as I can tell, there's no consistent method of determining whether a news has been priced in already or not. Take in point the possibility of Greece leaving the Eurozone after the elections this Sunday. You have some investment banks saying this is priced in Euro, while you have some banks saying, nah, if that happens, then your Euro is going to really sell off. So what is the truth? We don't know. So again, there is that problem. Okay, and it creates even more stress when you're planning your trade. Okay, before we move on to straddle trading, let's talk about some textbook theories on how the price of a currency should be set. Generally speaking, the market, or at least the textbook, says there are three theories on pricing Forex. One is the macroeconomic balance approach. That says that if the economy of a country is strong and healthy, then the currency of that economy should be strong. Does it work? Sometimes. Certainly, this case applies to the argument of why your Australian dollar should be stronger against the euro because their economy is strong. There's also this interest rate parity theory. This is a favorite among the dealing room of banks. Okay? Interest rate parity theory simply says, where will our money be more productive? Would we make more money if we keep our customers, our clients' deposits in euros? Or would it be better for us to move that money to Australia because they have higher interest rates? Or would it be better for us to move that money to Canada because we expect that Canada will be raising rates? So interest rate parity theory simply follows interest rate changes. And this is the favorite method of many classically conservatively managed treasury rooms. They just look at where can we get more for our money without doing much work. And then there's the balance of payments theory. Although balance of payments hasn't been followed by the market since 2008. But back in 2004, 2003, 2005, market moved on balance of payments theory. And basically that argument goes, where is money or which country is seeing an inflow of money? Okay, which country is seeing an inflow of money because it exports a lot? Now, as I said, back in 2003, 2004, 2005, this was a big issue. During those days, people would focus more on trade balance data rather than the jobs data. Okay. Now, these days we're focused more on interest rate data and macroeconomic balance data. There are actually, or the different economic indicators that we get can actually be classified according to the three theories. When you talk about industrial production, when you talk about manufacturing, when you talk about PMI, you're basically talking about macroeconomic balance approach. When you talk about inflation, when you talk about rate cuts, then you're talking about interest rate parity theory. And when you talk about current account, when you talk about trade balance, you're talking about balance of payments approach. Okay? Now, these different theories compete with each other on which is important, on what is the market focused on throughout the trading week. So there's no single approach that I would say is perfect. Each of these three theories compete with each other. And actually, personally, I have another theory. My personal theory is look at the stock market. Why do I say that? In the introduction of this module, we said that the textbook has to be rewritten. Okay, this is textbook approach. Why do I say that the textbook has to be rewritten? Because these days, we are in a period where the only thing that we really ask is, when is the next quantitative easing round? That's the only thing that we're asking, really. In the end, we're asking, when will QE3 happen? Well, when will LTRO3 happen? When will the APF in the UK be raised? And it's this question of when will money be printed, which is really driving the market. If we get to hear about news that is so bad from the US that people would start talking about maybe QE3 will happen, guess what happens? If the QE3 story comes out again, people would start dumping the US dollar, even though no new money gets printed, at least not until QE3 happens. So what's happening? Basically, buying the rumor is happening again. So that's really a problem that we have. The textbook does not work consistently, especially now where we're all concerned about the printing of money and what the impact of money printing is going to be. All right. So does that mean that I don't trade the news? Well, that gives us, or that leads us to straddle trading. Instead of trying to memorize or trying to get a PhD in economics, what I propose is that let's trade the market dumb. Anyway, we know that if data gets released and the data is far from the consensus forecast, we know that it's going to move the market. So why do I have to read tons of books to figure out what would happen? Let's just wait for price action. Okay? Now the problem is if you wait for price action and you do things manually, you go market order buy, market order sell, you'd probably end up being late. Statistically speaking, it takes the market 4 seconds to develop a clear idea whether data is good enough to rally on or data is bad enough for us to see a sell-off. It takes only 4 seconds before that initial uptick, initial downtick, and then the rest of the market follows. Think about it. If you're trading the market and you're thinking, I'm going to do buy, order, market buy, market sell, can you really decide what to do, which currency to trade? and press all the buttons in your platform within that 4-second window after seeing the knee-jerk move up or the knee-jerk move down. So what is straddle trading? When you say you're straddling something, you're basically saying that you are at both sides. That's why we say that we're straddling a horse, because both our legs are on the opposite side. In finance, in trading, when we say that you're straddling an instrument or a contract, basically that means you're holding longs and shorts of the same contract. Now, for us, for this particular discussion, we would define straddle trading as using pending orders for getting price action on either side of the market. So a straddle basically would be a buy stop and a sell stop at the same time. If market breaks lower, then our sell stop gets triggered. If market breaks higher, our buy stop gets triggered. When do we use straddle trading? Straddle trading is basically used when you're waiting, you're tired, you want to go out to watch a movie, you're so bored about the congestion. You can use a straddle approach. You can put a buy limit, you can put a sell limit. Another time that we use straddle trading is if there's news that's coming out, which is our topic. If economic news is coming out, we can use straddle trading. You don't have to overanalyze what the data means, not before it gets released. Okay, relax before the data gets released. And then when the data gets released and you have a straddle, you react to what happens. Whether market moved up or market moved down, you react only after you have seen the data and not overanalyze the situation, that you stress yourself out, you start making the wrong decisions. Believe me, I like trading news, and I've often found that if I stress myself out too much thinking what would happen, you know what would end up with my trading? I plan on trading Aussie, but I end up trading EUR USD. This line? This is not data straddle. This is basically a congestion in the dailies. So another time that you can use a straddle is if somehow market is not moving, and then all of a sudden you hear a lot of news about a specific instrument. Whether we're talking Forex or we're talking commodities or we're talking CFDs. All right. Now, when is it a good idea to do a straddle? Okay. Normally, I would use two criterions on whether I should use or when should I do a straddle, and how should I trade stuff. How should I take a trade? Which currency? Which instrument should I trade? First consideration is, when is the release? If you're going to get data released during the Asian session, Australian data in particular, Australian data, Chinese data, they normally have a textbook impact on the market. You have a break lower, you have a break higher, and then if numbers are really, really good, you get a rally. If the numbers are really, really bad, you get a sell-off. Okay? That's what I like about the Asian session. When you get your breakout, you don't get the confused seesaw action that we normally see in the US session. The US session sees a seesaw action because basically during the US session you have so many traders with so many interests. Some guys who are based in Europe want to get out of the market. Some guys who are based in the US are still jumping in. So you get a whipsaw. What instruments do you want to trade? You don't want to put a buy limit, sell limit on everything. You choose the type of instrument according to the data that you're expecting to come out. What do we mean by this? If the news is about inflation, then the likely movers on inflation-related news is the euro, cable, yen, gold. Gold will probably go up if inflation data goes up. Now, if the data that you're talking about is growth-related, meaning it's manufacturing production, it's PMI data, it's jobs data, then you look at your commodity currencies, or maybe you look at your equity market. If data shows that the economy is going strong, doing well, then you expect that maybe trading your Dow or your S&P 500 would be a good idea, since these would benefit on a strong economy. So you choose which instrument, whether you're talking currencies or other stuff, when you do a straddle trade. You don't just put it on everything. I guess you can put it on everything, but that's going to stress you out, monitoring everything. Now, once you've placed a straddle, you manage it according to some rules. Okay, what are these rules? Well, normally I would use a big target. Just in case you have a very, very good data or a very, very bad data, go for that 100 pip target. Besides, if you don't get 100 pips in the initial swing, after 15 minutes, you can always manage the trade down. You can always adjust your profit target as time goes by. But if you use a 10 pip target and data was very good or very bad, that you had an 80 pip move, you'd feel sorry for yourself. As we said earlier, it takes the market only 4 seconds to react to data to come up with a conclusion. Now, this means that if you see in your chart that it's stalling after the first 3, 4, 5 minutes, you're stalling at a certain price level, then it's a good idea for you to try to take some money out of the market. If after 30 minutes you're stuck at a price level, then maybe it's a good idea for you to close your trade already. All right, now let's see how should we trade the market with a straddle. The EA that I've distributed basically would put a buy stop, a sell stop in the market automatically for you. We will do that with a demo afterwards. But what it does is it would put a buy stop, sell stop within a couple of seconds. I think it doesn't take more than 2 seconds to really have the orders placed. If it takes more than a second, in fact, there's probably something in the dealer side that's preventing it. But anyway, it places a buy stop and a sell stop. It places target profit areas, and it also places stop losses. For myself, my preferred way of putting a stop loss is this. If a buy stop was placed here and a sell stop was placed here, I would like my take profit to be at a certain number of pips, and I would use my sell stop area as my stop loss area. Anis, yes, EA scripts can be blocked by the brokers if they want to. They just have to deactivate it from their end. Or they can screw it up by using a plugin. Well, Boyki, the spreads widen because none of the market makers want to have a trade in their books during the release. Okay, they want to take advantage of the release. They want to jump the prices first, and then they don't want you to take a trade just before the release because they don't know whether they will cover it or they will just allow it in their books or they will call another bank, can you take this order for us? Can you cover that order for us? So they don't want to do that. Exactly. They want our money. And they're not sure if they're going to win if data is coming out. Even those that use algorithms are not sure where market is going. They're just fast in coming up with a new price. But until the data is out, they're not sure. So this is how a straddle would look like. Again, this is a Canadian dollar. This is for NFB. I actually like looking at the commodities during an NFB release. Unlike your, this is by the way a 15-minute chart. Unlike your euro, we normally would have plenty of time to analyze, reanalyze before the market either goes back to where it came from or sees a follow-through rally. My EA, what I do is I would put the EA 5 seconds before the release comes out, and automatically the limits and everything is placed for me. By the way, the EA is also an OCO, which means that if one order is executed, then the other order should be removed. Now, here's what I said about Australian data or economic releases during the Asian session. Normally, they tend to see consistent price action. This is our 5-minute chart for the GDP release of Australia last week. And look at what happened. You see a steady movement in the market. Okay? 5 minutes after the first, actually it takes 1 minute only to make this candle. And then market stops, analyzes what happens. Okay, let's move on to the EA itself. So guys, the EA that I'm introducing or I'm giving away is what I call Straddle Trader EA with OCO function. I don't suggest that you test it, that you use it immediately on a real account. Try it on demo accounts, be familiarize yourself in how to use it. Now, the way it works is it will put an offset to whatever the market price is at the time you drop it on the chart. Okay? You input the number of contracts. By default, I set it at one lot. You can change it. You can save the settings. So if you trade 10 lots, you can save it at 10 lots. The take profit is determined in points. The stop loss is also in points based on what the bid and asking price is during the time of the release. Now, let's see an example of it. Let's try to use it on a chart. Let me just do this. Let's use a demo. And what do we have here? Let's go, what's moving? Let's go euro. Let's go dollar yen. And let's drag the EA. So your EA should be placed inside the expert advisor's button in MT4. The way to use it is you just drag it to the chart that you want to trade. Again, normally, just to avoid jumping in too early or jumping in too early that markets already moved on or would leave us behind, I would want to place it around the last 5 seconds. Sorry. Can you see my screen now, guys? You should be seeing an MT4 platform. Okay. So basically, you just drag the EA, and okay, some pointers. Every pip is worth 10 points, so it's designed for a 5-digit broker, but it will adjust itself if you're using 4 digits. Number of lots, take profit, and sell stops would be placed 35 pips and 5 pips away. If you want to use another setting, you can go save your settings. So if you trade 10 lots, put in 10 there, and then just save it. I'm not going to do that. So once you drag it into your chart, expert advisors are on. The details of your straddle would be placed on your chart as well. Of course, you can see it in the account itself. If there is an error somehow, it will tell you that the straddle was not executed. It will give you the reason on what the error is. If you don't have the function for opening and closing levels on, it will place an arrow on your entry levels. Okay? So it'll put an arrow on where your buy limit is or sell limit is if you've deactivated that if you deactivated the show trade levels function, it will put those arrows. So that's how it does. And if either side gets executed, say the buy stop gets hit, then the sell stop will be removed. And of course, we'll wait whether your stop loss gets hit or your target gets hit. Now, the way to trade straddles is you would want to take some profits. Again, as we said, if data is getting released, it takes the market only 4 seconds to determine whether they would like a follow-through rally or they won't. So after the first 5 minutes, you see that the prices are stalling already. Book some profits. And if market does not follow through with a rally within the first 30 minutes, probably you have seen the impact of the data already, and you're likely to pull back a bit, maybe even end up right where we were when things started. By the way, if you use the EA, be sure to remove it, especially if you're closing your platform. Okay? I've made this mistake myself when I was using it for myself. I forgot about that function. So if you have it on and you turn your PC off and you turn it on again, or you turn your platform on again, it will open another order. There's no way for me to program that it won't do that. So be sure to remove the EA once you're done with your straddle, once you're done with your news trading. So guys, any question? I think we only have about 2 minutes left. Questions, comments, complaints? So again, rather than stress yourself out to figure out what to do when there's a news release, I would suggest using a straddle. Aroma, you should put the file inside okay, let me show you guys. You should place it in the experts folder. Okay, place it in the experts folder of MT4. And then you should close the platform and open it up again. That way it's available to you. Just play with it, folks. It only works inside MT4. Sorry, but that's the only language that I use for now. Okay, guys. Questions, comments, complaints? If nothing, try it with a demo. And then if you try it with a real account, I will wish you good luck. Thanks for joining, guys.